Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. There is a lot of buzz in the market that in coming days, Fed might go and cut interest rate by 50 basis point or 75 basis point, and some economists are also predicting by the end of the year they are going to cut 100 basis point. Let us understand what are the factors which Fed is going to watch before making a decision. Now, before making any kind of decision, Fed is going to watch two kind of data. Fed has two mandates. One is full employment. It means that how the labor market is doing. Second is price stability, which means what kind of inflation is there in the economy. And last week, we have seen that unemployment rate is on an increasing trend. In coming days, on 14th of August, US CPI data is also going to come, which is going to pave a path for Fed that how much they are going to cut the interest rate in coming days. Now let me show you an interesting data point which is going to tell us that inflation in US is coming down. There is no doubt that inflation from 9% it has come down to 3.2%, and we are expecting it to further go down. Let me show you an interesting data point for that. If you see the table, you will find that there are two lines. One is a blue line, one is a red line. Blue line shows that discretionary inflation has come down below 2%. Discretionary inflation means inflation on luxurious item. Non-discretionary inflation is currently trading above 2%, but we are expecting it to come down close to 2.5% in coming days because of the lower housing cost. There is one more reason which explains that Fed is going to go and cut interest rate. The reason is real rate of interest. Now let us understand real rate of interest क्या होता है. Suppose if the interest rate in the economy is 3% and inflation is 9%, then an investor is on a negative side as he is not earning anything, negative to the tune of 6%. So let me give you one more example of positive real yield. If the interest rate in the economy is 7% and inflation is 5% and investor makes up 2%. In 2022, US was in a negative real rate of return. For example, at that point of time, interest rate was 3%, inflation was 8.6%. So the real rate of return was negative, which was minus 5.6%. At this current point of time, real rate of interest is positive. Why? Because interest rate in the economy is 5.25%, inflation is close to 3 to 3.2%, so the real rate of return is close to 2%. In the history of last 70 years, we have observed that whenever Fed is in a real positive rate of interest, they can go and cut the interest rate. Now let us understand what is the impact it is going to have on dollar index. From March 2022 से लेके जुलाई 2023 तक Fed has increased the interest rate by 5% approximately. At that point of time, if you see the chart, dollar index has moved from 95 levels to 114 kind of levels. It means that when Fed was doing quantitative tightening, supply कम कर रहा था, dollar index has shoot up. Now, from last 1 year, August 2023 से August 2024, Fed has kept the interest rate at the same level, and if you see the chart, dollar index is trading in a consolidated range between 107 on the upside, 103 on the downside. Now we are expecting that Fed is going to go and cut the interest rate to the tune of 50 basis point this year. If this happens, then we can assume that downward trajectory of dollar index has started. So basically in dollar index, we are expecting a level of 102 first and then 100. Now let us discuss outlook on rupee. There is a new buzz in the market regarding Hindenburg versus SEBI case from last 2-3 days. But initially equity market might react negatively to it, but eventually market will calm down. And as far as rupee is concerned, it is not going to have any negative impact because of that. In the shorter time frame, it seems that rupee has isolated itself from rest of the world, as it is not moving as per the global market trend, as RBI has been buying dollars on every dip, and we are expecting the trend to continue for some more time, and rupee might trade in a consolidated range between 83.85 on the lower side and 84.05 on the higher side. They say the more you compress an asset class like a spring, the more it will get volatile when it is released. The day when RBI is going to remove its hand, that day rupee will become very volatile. In that kind of a situation, ideally exporter and importer should focus on their hedging policy rather than focusing on rupee value. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of them have started taking costing near 83.75 to 83.80 kind of level. For them, we will suggest that they should cover 80% of their exports between 83.85 to 83.95. For remaining, they can wait with a stop loss of 83.70 or costing, whichever is higher. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. We would suggest them that between 83.85 to 83.95 they can cover 55 to 60% of their annual year turnover if they are hedging on an anticipation basis. If they are hedging on a confirm order basis, they should cover 75 to 80%. Now let us discuss strategy for importers. In the last 45 days, importers has really not got any chance to buy and cover their imports. But if you see rupee chart on a daily and on a weekly basis, it is showing that it is trading in a overbought territory. So ideally, importers should keep a stop loss of 84.05 and wait for some time, as we are expecting the pair to retrace back towards 83.80 to 83.65 kind of level, where they can cover 50% of their near term imports. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.